operating the T-bills market were unchanged despite some level of market activities on the short to mid-tenor securities. Traders at Access Bank say that they expect the market to adopt similar positions today. Senator Audu, a fixed income trader at Access Bank, joins me now for a weekly wrap of the markets. Talk us through what they were seeing play out in terms of sentiments this week and what's been driving investors' positioning.
Hi, Kenneth. Good morning. Thanks for having me. So as you rightly said, there's been a bit of a bearish sentiment across the fixed income market. This is largely as a result of the low liquidity environment that we're currently experiencing. So market liquidity figures, we saw market liquidity open the week on Monday in a repo of 24 billion. We've however seen these conditions improve slightly. As closing yesterday, we saw those liquidity figures coming at about 44 billion positive yesterday. So we saw the open repo rate decline from about 15% opening the week to close at 11% closing yesterday. This low liquidity level situation has affected the fixed income market. We've seen the bond market largely trade on a bearish note. We've seen the most active bonds be the short-end bonds, particularly the 2025s. That bond closed at the last auction at 11%, but we've seen it trade at 12.15% in the secondary market. The other on-the-run bond, the 2032, it's closed at 13% at the auction, but we've seen it trade slightly above that at 13.2%. On the Treasury bill side, we've also seen the bearish sentiment rear its head. We've seen that sentiment largely on the mid to short tenured maturities. We've seen those interests, particularly across the January to March OMOs. We've seen these bills trade at around 10% levels. We've seen corresponding bids on the short tenured maturities, particularly the special bills, the longest being the 28 November special bill. That's the longest special bill with the most interest. We've seen those bills trade at about 12% levels.
Yeah, but Senator, I'd like to take you back to the bonds and more or less what you're expecting from the next week auction.
Okay, so there's the bond auction to be held next week. So as I explained, in the secondary market, we've seen these bonds trade at significantly higher levels than where they closed at the auction. To reiterate, we had seen the 25s that closed at 11% trade at over 100 basis points more at 12.15%. So we expect that sentiment to feed into the auction. So we expect the bids to be a bit higher, and we expect the stop rates to close higher across the three maturities on offer, which are the 2025s, the 2032s, and the 2042s.
All right, now, but on the FX markets, though, what has been driving sentiments this week? And as you look as the market is going to position into next week, what can you anticipate is going to play out?
Okay, for the FX market, we've seen the CBN continue with its interventions. We've seen the CBN come into the market this week to conduct the intervention for small and medium-scale enterprises, as well as invisibles requests such as school fees, personal travel allowances, and the likes. So we saw that intervention happen on Monday. This week there is no retail SMIS auction, but we should see the results come in today. In the market, we've seen a bit of an appreciation. So closing yesterday, we saw an appreciation of about 3 naira and 92 kobo. We saw the NIFEX rate close at 424 naira 83 kobo closing yesterday.
So what's your more or less your assessment of the reserves, and are we likely to see some improvement anytime soon? The FX reserves.
The reserves, okay. For the reserves, we don't expect anything to significantly shift in that regard. We expect the reserves to largely remain at those 39 billion levels in the near term. And that's largely because as a result of the fact that the CBN has maintained its interventions in certain regard and has always ensured that the country has maintained a robust reserve position. So we don't expect any significant shift, at least in the near term, in those FX reserve figures.